what affects the price of these things? End of the day, investors are looking for a return. So when you buy Anglo-American, you're looking for the dividends, you're also looking for the price to go up. When you get into the bond market, what are you looking for? Well, the core you're looking for is a return, which comes out of the interest rate you're buying. Depending on the amount of risk you're taking, if you're taking time risk, you can also take a perspective of capital gains, because in this world, if interest rates drop, the value of your asset goes up and you can make a capital gain. But what affects the pricing of these instruments? At its core, interest rates are affected by inflation. The pricing, the value of money affected by time and the change in underlying cost of goods. So at its core, all interest rates should take into account what the people expect future inflation to be. Now all that does is protect your purchasing power of your money. Over and above that, investors want some additional return. So when you get to looking at government yields, there's generally an incremental return over and above what people think inflation is going to be, for the fact that you're taking some time risk, you want some return on your money. And so you can go beyond that. If you're going to lend it to a small company who has a degree of probability that might not be around in 20 years' time, you add to that basic incremental yield that you would ask from the government for that probability that might not be around. But yet, if you look around the world today, the yields internationally are such that they're below inflation. So if I say that it's affected by inflation, why are people buying instruments where the yield is below the cost of money? I think in many respects around the world, we are in an environment where people are looking at return of capital rather than being too worried about return on capital. So, for example, lending your money to the American government for 10 years at extremely low yields, which are below inflation, you have a high degree of confidence that they will remain around and you will get your money back. The banking system is proved to be problematic and not robust over the last few years, so putting your money in a bank comes, in the average person's mind, with a significant amount of risk. You don't know whether in fact the banks will be bailed out next time. So that's why around the world people are putting money into what looks like an irrational investment, something where the cost of money is not even being recovered, but it's linked to the decision that I'd rather get my money back, lose a bit of purchasing power, than not get my money back. So I think that's one of the core factors driving that. But in a stable, well-run economy where we don't have these kind of factors, it's driven by inflation and incremental inflation, if you're linking that to the government, and then adding to that incremental returns for the degree of risk you're taking for the entity you're lending to.